throw it in an extra update. I just did one a couple of days ago, but I need to catch up anyway. It's after the holidays. I also said I'd go into the general markets more, so here we are with the general markets really in focus as Bitcoin hasn't really done anything pretty much at all the past few days, at least not in any larger sense. So, what better place to start than with our crash tracking chart? We're still setting up the pitch quite beautifully. You can see here on previous crashes over in the 90s, that run we had, which was a great run up until the year 2000. We had our first kind of tech bubble crash. Interest rates dropped, unemployment rose, price got stuck into a rising wedge, fell out of that pattern, and came down into that rising inflation. Along with bottoming interest rates. And bottoming interest rates are typically a response to increased, not inflation, increased unemployment. Sorry, I'm not re-recording this. Um, that's the orange line, the unemployment line. Light blue, this teal blue line. That's our interest rates. I don't have inflation on here. I don't think inflation itself is as important a number or an indicator of the market health as the response the interest rates are. It seems to me that the interest rates and unemployment are really kind of your big indicators for these big market crashes and downturns. You can see where interest rates plateau, they get high, they plateau. Same thing here in the mid 2000s. Before the 2008 crash from that financial sector, interest rates rose as unemployment dropped. Unemployment got to a low, interest rates hovered at a high, markets continued to rise in a channel, and then again, they as interest rates dropped and unemployment rose, markets dropped down to the bottom, just about bottoming at peak unemployment, but not exactly. Unemployment did continue to rise, and alarmingly so. I think the biggest response here was that bottoming of the interest rates, where money became uh, affordable to borrow again amidst this huge drop. And during this correction, even some chop here at the lower end of this correction, where people might have thought it was going to fall apart, you can see the unemployment beginning to lower. That's a great market health sign, because as that unemployment squeezes down to lower numbers, the market has plenty of room to build up. I mean, you got people working, you have people earning money, and they want to spend that money or save that money, and they throw that money into the market. It becomes available, especially when you have that low unemployment combined with low interest, and you can see market spikes when that happens. And we do have a COVID deviation where unemployment shot way up. We had no indication really beforehand. It just exploded as we shut down as kind of as a nation. And but we did get is at the same time we had been stair stepping up our interest rates to test the waters there, and then bringing you see pulling it back down as the markets got choppy from this test. We had a small plateau. Markets got choppy. COVID came in, knocked up the unemployment rate. Markets panicked and dropped on that COVID deviation. Now, this doesn't show the low. This is a line chart, not a bar chart. But that wick is way down here. It's not. It's not just this small, relatively small correction of was that looks like 20%. No, it was much closer to about 50%. We came down with that wick until the markets rose back up again. Unemployment, as we started to open back up, unemployment bottomed. Employers were looking for people to employ, hunting them down. We're still in a fairly competitive market. We're still fairly low on unemployment, and that, I think, is what's been really holding up the market. Is this low unemployment number that we have? And look, you could say it's manipulated all you want. Doesn't seem to matter. Um, Interest rates super low, markets spiked up. This is where inflation came in, was in this decline that we had, but it just came back into the bottom, right? It helped to form this channel we're in. Um, yeah, we really didn't um, break out of the bottom on this one or on this one. We had a kind of a double test. In we talked about the possibility while we're here that this could be a lower high and we could roll under and test into these ranges. But that didn't wasn't the case. In fact, I think my last long on the S&P 500 and my last big buying opportunity that I had was here on this dip as we came back to test these highs around that 4,000, above that 4,000 mark. And it's been progressively higher since, with a few small deviations. Like this little bump you see here was just August of this year, and we've continued to rise and rise and rise um, as interest rates remained high and plateaued. Well, now they have some breathing room, and we've started to decline on the interest rates. We came down a little bit further. In fact, I had drawn this arrow as we were topping out. We hadn't finished topping out yet. And I drew it sideways and then down. And the interest rates have really, I haven't moved this thing. I promise you. The interest rates really have moved that out and about. So I'm going to, I'm just going to remove that and I'm going to put in a new arrow to clean that up some because it doesn't need me to be quite that specific anymore. Let's just put it in the exact same way it was. Actually, that was a little larger. There we go. So that's really what we're looking for. Interest rates should continue to fall. If unemployment continues to rise, and as these two begin to cross, that could be our indication. Usually, a good indication that we get into at least some corrective action. Now, most likely, I think what typically happens is we get a corrective decline, and that corrective decline could be just a test under this range. It doesn't have to be one of these big market crashes. We could just test under the range at about 25% decline. Now, previously, this 25%, when I originally marked it in anticipation, was down here, which makes a lot of sense with the tops and the bottom. That's about 30% now. So I had to pull it back up. Now it kind of aligns with some of this chop top up here in the top of this. So that makes a little more sense. It's about 25%. Our 50% decline, we had to move that as well. It was down here at the bottoms uh, of this range. Now it's up at the tops of that range. So it's just shifting from the bottom of that range to the top. This is about 55, 60%. Yeah, about 55%. Then we have 70%, which was down here at 75. That's moved up about 5% here. This whole top of range, about 75%. Like that would be a major crash. So a corrective structure to reset everything here. This is a mild corrective structure. This isn't even this. I wouldn't even consider 25% an actual crash. These big crashes that we have are usually about a little over 40% in that 50% range. It's the most common. This is the most common range of larger declinations is about 50%. And we've only had very few exceed that number. And we're talking like Great Depression type numbers where we hit that 70 to 75%. That doesn't usually last very long either. To me, that'd be worst case scenario, but landing anywhere 50%, maybe even down to 55 to 60%, I think that would be a kind of a standard crash scenario. I, if we got down into that range, I would absolutely be looking to buy up anything of value in the market. Yeah, I just yard sale, just sell anything I have I'm not using currently. Just buy up assets in the market. That's typically when you like look at these pikes down here at the bottoms. You usually get we got a little bit lower here, but not for long, right? So if you're an investor or a long term holder, these big 50% declinations are like Christmas come early. Well, I know it was just Christmas, but Christmas come early. You guys know what I mean. Anyway, let's move on to some closer charts. Do I want to start with the Qs? Nah, we've been talking about the S&P. Let's start with the SPY. Eh, Not great looking tops up here. We're starting to get, and we're starting to fill in this gap finally. We had, right, with this one candle kind of dip down in, but we still have a gap down here to about 576 left to fill in. Right now, we've kind of hit the top of this FVG type demand um, or supply zone up here, right? So we had some volume up here in the top. We came down really fast. Market recovered to kind of fill in this range, fill in that single print candle. Then we hit the top of that volume range and rejected. So to me, it's looking like we come back down, finish filling up this gap. I think that's kind of our minimum next move early in the year. I can absolutely see, um, yeah, the this week, particularly midweek, after the New Year's holiday, we start to get some of that profit taking for tax purposes. And at the very least, I'm looking for a test here about 576, quite likely down here to the tops in this range, kind of around that 560 level. Um, retest that volume range. Now we may get a bounce from there, or it may continue from there, but that does lose our upward trend that we've had for a while since that fall in August. I mean, we've already lost it this time, and you could say that we've lost it and failed and rejected a retest of it. So this wedge that we've been in, it's, I can't. You ever have one of those days? This wedge we've been in for a while, right? So we've broken it down to the downside, which is really common. I mean, it's an upward, it's a rising wedge. They don't always break down. In highly impulsive markets, they can and will break up, and we've seen that especially in Bitcoin recently. A lot of these big spikes come at the ends of these rising wedges, but we've had so many of these break up rising wedges back in here that it was due for one to come down into a corrective structure. Now, if we come down, I'll change this arrow too. I don't like that, but as we come down, and we start to fail upper tests, that's when we can start building these. Let me go and change that now. That's where we could start building these corrective structures as we come back down into supply zones and supply areas and test some of these lows that we've had down in here, possibly even to targets on our larger patterns. Now, those targets, which are still valid as we've not exceeded the hop level, these larger targets are all the way down here at 41 to 431. And if we came down, I think, and tested maybe a fake break of this trend line, I mean, that would be really interesting because it would get us right now where we were looking at. That 50% decline was about here, right in between these two targets. So if we faked a breakdown into these, sorry, not 50%, or 25% decline, and start testing these upper structures either here or maybe like 30% here, um, that could be all we need, right? That could be all the correction we need. So we hit this big demand zone here, and then the markets could lift back up and take off. So we'll need to watch. I'd be really interested in seeing the reaction in here if we came down in here. But that's my plan for 2025. Now, if instead we come down, fill in the gap, and rise, we could rise up into the hop before that declination. Yes, I am still looking for the market to turn down until we exceed this. And I mean, exceed it like somewhere up in here on that 536 mark. And at that point, the markets are quite likely just going into a ballistic run. I don't know if that fits the narrative for me quite well enough, but the market's going to do what's going to do. It doesn't really care what I think. I can only trade the price action as I see it. And for right now, this is the plan that I have in place for if it gets to these levels. Um, the Nasdaq has better structures. Let me pull up the Qs because we can trade off of these two structures. Like we came really close to already hitting that target one off of this. So we got our reactive move right after pattern completion, formed another pattern, this butterfly. That butterfly went up to the hop, which was this white line, and we got a reaction right off the hop. Now we've hit our our prior gap support, which is also the 1618. I can erase that because you know what it is now. And we've gotten a small reaction out of that. I did mark this blue line was my mark of the completion of the butterfly. Yeah, it got a little bit higher, but it's still within range. This is the target zone we have. So if this doesn't continue to rise, if instead we break a new low, um, with with the new year coming, if the market decides to sell off, we have a little bit of a gap in here to fill, about 492, and then I'd like to see this level here of support. I'd like to see that level tested one more time, and then that could be a type 1 or even a type 1 into a type 2, and then we fail our rising trend line on the Qs. Um, Maybe get a bigger reaction out of that before falling down into our targets. That's kind of my year-end review for the Qs and for the SPY. Again, the Qs have the hop level right up here, and I won't ignore these bearish patterns, these bearish structures we have, um, until we're blown over these levels. Will I miss opportunities on these assets? Probably, but if you guys know me and you've been keeping up with my stock picks or any of my other asset charts, you know that I'm still buying. Like I'm always still looking for the next deal. I love finding things at just absolute bottoms and lows and putting money into them. And that's how, even when I'm bearish, I'm putting money back into the market. I'm just being more cautious with some of the markets that have been flying, and making sure to take my profits out and then reinvest. That's really all we can do. Just try to be good stewards of our financial capital. Let's go ahead and um, mark that gap. So we'll keep an eye there on that and see if we can't come back down at least into that level at 492. I would like to see this area between this gap and the support get hit, and then we get a rise. I mean, that could be a good trade, or we could always zoom into smaller charts than the daily, like maybe the 4 hour while we're up here on this double top and see. I'm not really getting anything super extended, but you know, if we open and close this little gap here and find it as resistance, because remember, like, we opened our short here at the hop as we failed under and held under instantly. That, I think it was the same day I posted the video, we fell down into our main target, which was to close this gap. So if we can rise into this gap and we find it just like here at this level, it wasn't a gap, but if like this level we find it as resistance, that could be our short, and then we could run down to about this level here at 492. So we're looking to hit 529.57, find a rejection, then we'd open short on the Qs and run it down to 492.88. And that would be another short trade to add on to the one we had here uh, last week. So anyway, like I said, the Qs have better structure. It's just right now they're easier for me to trade than the S&P. And I haven't really looked at the Dow in a while. The Dow hasn't been giving me much that um, you know, again, another break under that rising wedge, just like the Qs have. But we lost our structure on the Dow, and I need to go and clean all this stuff up because I don't have these same, I don't have all these same targets that I had because I lost the bearish structure that I could have been on this. That we went too high. And yeah, I'm gonna take these out because they no longer apply. Um, but for the Dow, look, if we range and we start to build structure, I'll come back to it. It's just I prefer to trade in these larger indices with a little better structure in mind to go with the momentum. Otherwise, I just go and trade my smaller charts, take my stock picks, and go play around with crypto. Because if I'm going to play with these, I need them to move in the direction I expect them to move. These are almost always big swing trades for me on these indices. Anyway, that's going to cover the major markets. I can look at Bitcoin really quick, but as I said, it really hasn't done much in the past few days. You can see just got a little bit of a declination here and took out this low, but this is all still within the middle of that range. We haven't committed. We keep making these higher lows. We haven't committed to a direction yet. These slight higher lows from here are what have me most concerned, because these now become massive, right? Liquidity wicks, and our liquidity is building in this range right here, where I really want to see it come down, sweep. That means come down, quick rise, and then try to catch that quick rise, possibly up in the range volume point of control, um, and also possibly up into the range value area high. Should we get there? That'd be my first immediate trade. If instead we hold these ascending lows, we could pop up, sweep the liquidity here, probably up to the value area high, maybe even, I'd have to see. It's like the first time every time I'd open that thing, I swear. All right, maybe even to 102, right? So we could wick here at 101, possibly at 102, sweep that liquidity up here. I don't think it's quite as much, but we could sweep that liquidity off the shorts and then come down to grab the longs. It's just going to depend. I mean, that gives us a little bit of a bearish W structure. I know that's bullish for a lot of people, but these structures typically mean tipping point turnover, right? As well. So, me, right. So this then becomes the center of your M. This becomes your other M point, and then what have you made? You just made you turn a smaller W into the center of a larger M. So that typically becomes your reversing structure, because you're always looking for that big lower high, or that big higher low, and I just don't think this is enough, right? Even if we make a little W out of this, especially with this anchor point, possibly even with this one, should we get up to that daily, say? I don't think that this structure here is enough to count as a large W to continue up. I could be wrong. But correction is really where I'm looking for beginning of the year, like very beginning of the year. And then I think, especially if we can swipe the liquidity out from under here, then we could open up the possibility, the easy possibility, without all the shorts in play anymore, the easy possibility of hitting that swipe and then coming back up and possibly even breaking up to a higher high. That could be our out for this session, and then form a new range up higher and then come down to test this area. Or we could be have the lower low, the lower high, and then come down and test this range we talked about in last week's video. But yeah, nothing much really has changed there, so I'm not going to talk about it much more. Um, Members, I'm going to try to get back on here this week and dig into the altcoins and maybe even some of the single stocks. Um, we'll have a members exclusive video on that one. But let me go ahead and close this one out and let you guys have have a good start of the trading weekend. We'll just see what happens. It'll be curious. Whole new year, and I'll talk to you guys later. Bye.